Japan's political earthquake cannot be ignored. January 30, 2026. Japan goes to the polls next week in a snap general election. Ordinarily, this might barely register. The country has had more than 30 prime ministers since the Second World War, yet the Liberal Democratic Party has governed for most of that time. Japanese politics is both unstable and oddly unchanged. This election matters more than usual because its outcome could ripple through global financial markets. Last October, Sanai Takaichi became Japan's first female prime minister after winning the LDP leadership. A tough-minded conservative who likens herself to Margaret Thatcher, she has also drawn comparisons with Liz Truss for her enthusiasm for fiscal expansion. Takaichi called the election to secure backing for a radical reflationary agenda, higher public spending, lower taxes, faster growth, and rising inflation. She argues this is the only way to escape Japan's crippling debt burden by expanding the economy faster than liabilities grow. Her plan includes a $135 billion spending package and a 2-year suspension of the 8% consumption tax on food. Equity markets have welcomed the growth story, but bond investors are far less convinced. Japan already has the highest debt-to-GDP ratio in the world, and markets are questioning how much more it can absorb. Yields on 40-year government bonds have climbed above 4% for the first time, while debt auctions are struggling. A key 30-year bond sale is scheduled just days before the election. There are two ways to interpret this. Optimists see Japan finally escaping decades of deflation. Rising yields could simply reflect a return to normal inflation. Most debt is domestically held, issued in yen, and yields remain low by global standards. If growth accelerates, the debt problem may ease. The darker view is harder to dismiss. Japanese investors are among the largest holders of U.S. treasuries. If domestic yields continue to rise, they may shift money home, pushing U.S. bond yields higher. That would be bad news globally: higher U.S. borrowing costs, pressure on emerging markets with dollar debts, a stronger yen that hurts Japanese exporters, and falling valuations for assets priced on future earnings. American technology stocks are especially vulnerable. Their elevated valuations underpin the U.S. market, and higher global yields threaten that support. The Magnificent Seven, after all, borrowed their name from a Kurosawa film, and that story did not end well. The knock-on effects could spread further. Private credit, property, infrastructure, and defensive equities have all relied on ultra-low interest rates. Few areas of global finance are immune to rising Japanese bond yields. This is not yet a crisis. But Japan has the world's largest debt market, a central bank stepping back from yield suppression, and a government seeking voter approval for looser fiscal policy. Even if you have never cared about Japanese elections before, this one is worth watching. By The Telegraph, opinion by Tom Stevenson, January 30, 2026.